Good morning, and thanks for joining us for Exonia Bank's Economic Outlook for 2021. Obviously, this is not the format we've had in previous years when we could meet in person. And I'm thankful for the team that's been able to put this together for us. For those of you who do not know me, I'm Dan Westrop. I'm the chairman and CEO of Exonia Bank. With me in the studio here is Mark Wehrman, the bank's president and chief lending officer, and Mark is going to deliver some closing remarks after the program. Also, not with us, except virtually, is our main speaker today, Ryan Detrick from LPL Financial. And before I introduce Ryan, who is an outstanding speaker and expert in the market and economic atmosphere that we've been in the past and are going to be in 2021, I want to thank Lauren Ruff and Josh Effinger from our marketing department at Exonia Bank for making all the arrangements to put together this program in the difficult circumstances in which we find ourselves. I also want to take a moment to recognize Jeff Taylor and Brianna Smith of Exonia Wealth Management, the bank's financial advisory professionals. In their roles with Exonia Bank, Jeff and Brianna are also affiliated with LPL Financial, the nation's leading independent broker-dealer. This combination of advisors exclusively serving local clients whose needs they understand well, with a company with the research and investment resources second to none that LPL enjoys, this combination creates a unique client experience. If you've not done so, I encourage you to visit exoniabank.com to get contact information for Brianna and Jeff for an exploratory consultation. A couple of housekeeping notes. To ensure the quality of today's presentations, we ask that you stay muted during the presentation and keep your cameras off if at all possible during the presentation. You're encouraged to ask questions, of course, at any time, but those questions should be submitted through the chat function, and Ryan will address your questions after his prepared remarks in a Q&A session that will occur just before Mark Wehrman wraps up. Finally, this section is being recorded and will be sent to all the guests after the presentation. Now it is my great pleasure to introduce Ryan Detrick, Senior Vice President and Chief Market Strategist for LPL Financial. In this role, Ryan has a direct impact on portfolio decision-making processes, and as a member of LPL's Market Insights team, develops and articulates equity and general market strategy. He's a frequent presenter to clients, industry peers, and the national media on emerging and developing market trends. Earlier in his career, Ryan spent over a decade at Schaefer Investment Research, focusing on market analysis and strategy. During his tenure there, he was widely quoted in national media outlets and made appearances on television and radio platforms such as CNBC, Bloomberg TV, and Fox Business. We are very fortunate to have Ryan exclusively with us today. So Ryan, welcome, and please feel free to
Here we go.
Yeah.
All right. Thank you, Dan. Well, you guys might feel fortunate, but I'm fortunate as well. And the partnership that Exonia and LPL has is something that's very special. And obviously, I saw you guys in person about a year ago. Due to the situation, can't do that this time. But hey, this is the next best thing. Hopefully, everyone from the comfort of their home or their own offices. And there's a lot to discuss, obviously. So we're just going to kind of get right into it. Now, I'm going to share my screen. We tested this earlier. It should work. Screen 2. Here we go. All right, guys. I believe you should see my screen now. So we should be good to go. 2021 economic outlook. It's just just make sure you guys do see the screen, right? We're good. Dan, want to jump on?
Yes.
Yeah, we're good.
Okay, perfect. I'm just making sure. I figured. All right, great. So Ryan Detrick, LPL Research, LPL Financial, chief market strategist. I get to do lots of fun stuff like this, right? I love presenting. I love traveling and getting to know people and getting out on the road. But my job's fun because I get to talk about the stock market, get to talk about investments, get to talk about the Fed, get to talk about the economy. And we're a 30-person research team. We manage tens of billions of dollars on our research team. So if you see me on TV, I was on CNBC yesterday at 5:50 in the morning. I think I'm just getting up that early, to be honest. But it's fun to do that stuff. But I love working with our team and our portfolio managers and trying to, where are the best investments for you guys, for investors, and our voice is a very big voice at LPL Research, and it's something I don't take lightly, but something I really do love, and hopefully you'll notice that the next 45 minutes. Like we said, I'm going to go about 45 minutes. Then we're going to have about 10 or 15 minutes of Q&A. So definitely get your questions. I guess you can send them in now, but we will get to them at the end. So the economy remains undefeated. Let's start here. We're going to focus a lot on the election, obviously. I know this is an economic update, but I think you probably want to know our views on the election. Talk about the economy, the stock market, the bond market, kind of do a nice, well-rounded view of everything. Now, we are fully aware it's not 100% official that obviously President Trump has lost this election. That's probably the way things are leaning. We don't officially know if we're going to have a divided Congress with the Republicans taking the Senate. It obviously looks that way with the two runoffs down in Georgia. But one thing that we talked a lot about is if you have a recession before an election, the incumbent president has lost the previous 3 times. And that's what this screen shows here. Ford, Carter, and George H.W. Bush. There was a recession. They did not win re-election. If you don't have a recession, you tend to win the re-election. Obviously, we had a vicious recession, which we're going to talk about. And that kind of obviously put President Trump behind the 8 ball in our view there's probably some other reasons, but that was one of the biggest ones, the economy. And that's potentially one reason why he might not be the next president. But, it's the old saying, it's the economy, stupid. That came back from Carville in 1992. And that was about George H.W. Bush in 92, because there was a recession before that. And that potentially opened the door for President Clinton to win that election. So that's just kind of setting the groundwork. But 2020 has just been so terrible. I mean, so many different ways. I mean, there's some light at the end of the tunnel. We're going to discuss that here in the next 40 minutes or so. But the truth is, losing over 200,000 Americans, millions, at least 1 million people, probably more that we know of globally. It's just been totally devastating, the death and destruction that we've seen this year with some of those vicious recessions. Just lost Alice Trebek. I mean, it started with Kobe Bryant, obviously. I'm a Cincinnati guy. Joe Morgan passed away recently. But the one that got me was Regis. I'm a fan of Regis. I don't like Notre Dame very much, but it's all right. But I know he was a big Notre Dame guy. But just the fact he was always on TV, always seemed personable, just really liked it. But I love this quote by Regis. I'm involved in the stock market, which is fun and sometimes very painful. Doesn't that sound a lot like 2020? I mean, literally, like as we're speaking, the S&P and Dow are just a chip shot from all-time highs. The S&P was down 30% for the year. All right, I know you guys remember this back in March. 34% peak to trough, fastest bear market ever, fastest 30% correction ever. Guys, this could be the first year in the history of the stock market that the S&P was down 30% at one point and finished higher for the year. S&P's up like, I think, about 10% or so for the year as we speak. This is a truly devastating and just phenomenal record-breaking year in a lot of different ways. But I think Regis really summed it up really well there. But so a little bit about me, more about me. If you ever get the opportunity to see me on TV and you have DVR, just hit pause. I guarantee you, my kids think this is hilarious. They watch me on TV and they hit pause. I'm always making a goofy face. So here I am, apparently playing a DJ in this particular image. Here I turned orange. I half joke. When I turn orange, it means I'm lying. So if I turn orange during this webinar, maybe think what you want from that. Here I am. I don't know. I make these weird things with my fingers. I don't know why. I'd like to think in public and in real life I don't look like that, but apparently you put a camera in front of me and I do. Here's Angry Ryan. This was March 23rd at the lows of the stock market, just the devastation that we were seeing. I was very, very mad that day. Funny thing about TV, they don't tell you when you're on TV. There I'm taking a nice drink of water with Tyler Matheson on TV just a couple months ago. There you go. And here I did a webinar from my house, and I think a ghost came up behind me in this particular one. So luckily I'm not in that room. I am in our office in Fort Mill, South Carolina, just south of Charlotte. So hopefully that ghost doesn't come and bug me. So let's get into it, guys. The election. We're going to start with the election and kind of how it all impacts the economy here. But obviously, you think about this year. So we had a president up for re-election. We all know that. If you go back in market history, since FDR in the 1940s, the stock market has been up every single year when a president's up for re-election. Yes, 2008's in there. That's not up for re-election. That was a lame duck president. When a president's up for re-election, it's one of those things that we knew in our back of our head all year. And that's not about Republicans, it's not about Democrats. It's about juicing the economy to try to get things improving so you can win some votes later that year in November. And once again, it's looking like that very well could play out, where stocks historically are usually higher during an election year. Or I'm sorry, during an election year when the president is up for re-election. So again, this isn't official yet, but we know it's pretty close. We likely are going to have a Democratic president. We likely are going to have a Democratic House, and we're likely going to have a Republican Senate. The last time we saw that combination in Washington was Grover Cleveland in 1884. I mean, that's amazing. He was actually the only president to serve 4 years, take 4 years off, and then come back 4 years later. So just a little trivia stat there. That's how long ago that took place. Just thinking about this election in general, I mean, one of the things that we said at LPL Research, and I've got some slides coming in, we thought the race would be much closer. We actually were on record as saying we thought there'd be a split Congress. Virtually no one was out there saying they thought there'd be a split Congress. We heard a lot about the blue wave. We saw some signs that said that's probably not the case. And you think about it, only 77,000 votes separated President Trump from Hillary Clinton back in 2016. If you looked at Michigan, Pennsylvania, and Wisconsin, only 77,000 votes. Those three states obviously flipped the election. This year, as of a couple days ago at least, it was 73,000. If you looked at Michigan, Wisconsin, and Arizona, when you consider the fact that we had the most people vote in our country in 100 years, or about 100 years, you could argue that things are even closer and tighter. And I understand if you add all the total votes up, but some of those swing states that really decide things, boy, oh boy, this really shows, I think our country is kind of getting tired of going to the extremes and really wants a little more kind of in the middle. And that's why we think a lot of the market has bounced. Okay. So that was when we talk about the reaction to what's happened. Clearly the election happened. We still, there wasn't a president the next day when we woke up. It took several days, and still, again, there's some legal battles and things. But what the market, we think, is reacting to is what I just talked about. The likelihood that we're going to have a split Congress. The Republicans right now have 50 seats in the Senate. There's 2 more out there in Georgia. They're favored. If you look at Predict It, which is a website that keeps track of these things, it's like 66% to win one of the seats and 68% to win the other. Again, not 100%, we get it, but likely the Republicans will retain the Senate. And even if they don't, it's 50-50, and Ms. Harris gets the final deciding vote in Senate with some moderates and things. It's going to be tough to kind of push through some of the more somewhat extreme higher taxes, higher regulation. We think that's why the market has done so well since the election is over, even though there's uncertainty over who the president, less uncertainty now, but there was uncertainty initially. Market didn't care. Market took off because we're going to have, in all likelihood, that split Congress. Talk in a second. But look at the screen. The S&P was up 1% or more 4 days in a row right after the election. Actually, I think Monday, Tuesday, Wednesday, Thursday of last week. So right through the election. 4 days in a row up 1%. Guys, that's extremely rare strength. What I want to point out here, last time it happened was 82. All right, October of 82. For those that remember back then, that was a start of an enormous bull market. Not saying it's going to be the same this time, just it's important to point out. And then had them to 70 and 74. Look at the future returns on stocks after 4 straight days of 1% gain. 6 months later, 15% average, a year later, 26%. Yes, we live in a world of disclaimers and compliance. We're not predicting that or guaranteeing that at all. I'm not doing that at all. What I am showing, though, is the strength that we saw around this election is extremely rare and tends to resolve higher. And that is, we think this bull market's alive and well. We think the economy is out of a recession. The recession probably ended last in the summertime sometime. It's not official. And we'll see expansion next year. I mean, we just had that news with Pfizer on Monday, which caused a big move in a lot of stocks. And a lot of those cruise ships and airlines are up 30, 40, 50% in a couple of days. The realization that hopefully we can get through this. I mean, we're not through it. All right, I'm going to talk about the economy soon. We're not through it, and there's still a ways to go. But there are some real positive. But the reaction to the stock market, in my opinion, is really impressive and something that we don't want to ignore. 2020 hasn't been good. Here's a little old lady with her husband. If we're going to watch the news, I'll need my glasses. You can see she gets up and walks away, and then she comes back with her 2 glasses. That's better. That's a good way to get through 2020. So I kind of talked about this already, but the idea of a split Congress. So again, it's not official, but in all likelihood, we have Democrats in the House, Republicans in the Senate, split Congress. This year could be the 11th year in a row that stocks gained under a split Congress. And you see on the screen on the right, that big blue one on the right, 17%. Stocks gain 17% on average when you have a split Congress. They do pretty good with Republicans and Democrats, but when you have a split Congress, things do really well. Why in the world is that? Well, there's an old saying, gridlock is good. The best Washington, maybe for investors at least, is one that can't get anything done. And that's kind of potentially where we are. Again, with the corporate tax rate supposed to go from 21 to 28% potentially, and so more regulation. We think those are totally off the table now. I mean, even if you get a 50-50 split and the Democrats get the next 2 seats in Georgia, we think that's off the table. I mean, there could be some taxes that increase along the way, but not to the extreme that a lot of people were expecting this time, 3 weeks ago or so. And that's potentially why the stock market had that big relief rally. But the fact we have a split Congress in all likelihood the next 2 years, that's something that we think is important to note. Now, here I just broke it down by different parties in different ways. So here you can see with the Democratic president in a split Congress, that's the one that's circled in red, up about 16% on average. And again, just to point out, we haven't seen the current makeup that we might see here with the Democratic president, Democratic Senate, or Democratic House, and Republican Senate since 1884. Truly amazing. Now, you got to quote Anchorman. They've done studies, 60% of the time it works every time. Brian Fantana. Let's not be Pollyanna. Let's not be naive. I mean, I'm throwing off some numbers and I'm going to show a lot of other things that do suggest, again, this bull market can continue here. But there's always worry, right? I mean, right now, who's to say, the market has a funny way of selling the news. We have a vaccine, extremely positive results. You all read about it and saw Pfizer, 90%, it works 90% of the time. Moderna is another company that you're going to hear a lot about if you haven't yet. They've got a vaccine that likely will have, what I'm hearing and seeing, similar numbers to what Pfizer just reported. So we've got 2 vaccines that are probably coming in the next couple of months here with some very, very strong results. That can help open things up. But who's to say from an investments point of view, where we rallied like mad in March and April? Well, March we sold off, but April, May, June, July, August. We had a 5-month win streak recently. All right, down September, down October. And before this day started, the S&P is up 8% for the month of November. So we're ripping again higher, making up for those losses. But maybe, now that we have some good news, right? Things are good. I mean, I'm not going to name who, but one of our major competitors just came out with an extremely bullish report looking for stocks way higher. We're still bullish too, but you do have to worry from that contrarian point of view. Now we're getting some potential good news on the vaccine front. But then you see the rolling shutdowns and the restaurants are shutting down in San Francisco, records of hospital stays, likely going to lead to increased deaths. I mean, we're not out of the woods at all. So I don't want to make it just sound like there's certainty that there's no certainty in life at all, but the markets have to go up. But we do side still with this bull market has a lot of life left. But again, let's just put it in perspective. But one thing to be aware of, I think is interesting. Maybe we're not so divided. We live in a divided world, divided times. We know that. But Mitch McConnell is a lifetime Senate member, right? He's been in the Senate a long, long time. Joe Biden been in the Senate a long, long time. President Trump was never in the Senate. President Obama was in the Senate not very long, right? He had other aspirations to be president. So one of the things we think could be at play that no one's really expecting, maybe these two, we'll call them wily veterans. Wily veterans can kind of work more together to get some wins. And what's the first win? I mean, it's another stimulus package, right? We need to help people that are still so impacted by this. Yeah, it's great. The vaccines look really, really positive. But it might not be in everyone's arm until the 3rd quarter next year is what they're telling us. I mean, that's like 9 months away. I mean, almost a full another year away. So we're still a long way to go. And obviously winter's here and people staying inside a little more and doing things inside. So there's some big concerns. So we know, but these two potentially lifetime senators understand kind of the inner workings of Washington, how to get things done. We're optimistic. Again, actually expectations are pretty low, right? We've had a very rough go at it with Washington, but we think maybe there could be a little bit more optimism to get something done. Now, this next stimulus plan, we think is going to be about $1 trillion. There are rumors of a $2 trillion stimulus plan a couple of weeks ago. We think now that the Republicans, again, potentially contain the Senate or maintain the Senate. I mean, Republicans also you gain seats in the House. I mean, nobody expected that. So the Republicans have a little bit of clout when you look at some of those other areas. Another wild one. Assuming Joe Biden's next president and assuming that the Republicans maintain the Senate, that's the first time since the 1880s that you had a Democratic president, a new Democratic president. So not the re-election, but the first year of a president that he didn't bring the Senate with him. And that's really rare. I mean, that's usually bring the Senate with them. With Republicans in 1960, 68, 1988, we had a Republican president first term, but he did not bring the Senate with him. Senate was Democratic. So with the Democrats, at least, they tend to be a package deal with the presidency and the Senate. And again, likely that's not the case this year if you look at kind of the odds and the way things are looking here. So that's just another unique way, I think, to really summarize just kind of how the world really is kind of coming together, and it's not so extreme one way or the other. At least that's kind of the way at least the votes made things look. So let's talk a little bit about the stocks and the reaction. You can see here, if you have a re-elected president that first year, that's the yellow there, 9.6%. Stocks tend to do a little bit better if you have a re-elected president. You have a new guy, new president, that's the green on the left, 4.8%. So, again, lots of different scenarios here. We think a lot of this has to do with you tend to get reelected if things are going good. I mean, that's the truth. I mentioned earlier about the election, right? Or I'm sorry, about the recession, how it really was a major hurdle for President Trump to jump over. Recessions are re-election killers. I mean, that's the truth. It's been that way for 80 years now. But it's unique because things would be good. Now, here's why. When Reagan won, I'm going to call it his fifth year. So you know what I mean? He won the re-election, so his fifth year. President Reagan's fifth year, President Obama's fifth year, and President Clinton's fifth year, the S&P gained like 30% every time because there's no uncertainty. Whether you like President Trump or you don't, you kind of know what you're going to get with him, right? Low taxes, low regulation, pressuring the Fed to keep rates low, and spending. I mean, there's more than that, I know, but those are some of the big things. Obviously, not Joe Biden, but any new president, there's always the uncertainty as to kind of what's going to happen with the new president. We think some of that is why you have a little bit weaker potential performance early. But check out the third and fourth year. Then you get those returns to some of the policies and things start to take fold and the less uncertainty in the economy. And again, get the economy going for a re-election tends to be what happens in that third year where you tend to see pretty good stock market returns. So just something to be aware of. We do have a blog, LPLresearch.com, where a lot of these charts that I'm sharing you can check out daily and sign up for, and you can love be honored if you check that out. So you've probably seen a lot of these. What happens under a potential Joe Biden presidency, right, or a potential President Trump presidency? We do it too. Everybody wants to talk about it, but here's the truth: when President Trump won in 2016, we were told he hates Jeff Bezos and Jeff Bezos hates him. He's going to go after big cap tech, right? He's going to go after those big names. Oh, by the way, steel and coal and financials are going to do great. Well, 4 years later, that's not really the case. Technology's done great. Steel and coal financials have really struggled. So it's not so clear cut. But at the same time, I want to at least spend a little bit of time on kind of what we see potentially with tailwinds here with the Joe Biden presidency. Infrastructure bill. Again, we're not probably going to get the same size infrastructure bill due to the makeup of the House and Senate. But still, there's going to be more of an infrastructure bill with Joe Biden. One thing you run on. And honestly, Republicans agree there. Republicans agree we need some type of stimulus for the people that are impacted. And we need an infrastructure bill. So that's where those, the two wily veterans, as I call them, maybe they can get together and kind of work more together than people give credit for. And we can get an infrastructure bill sometime soon next year, or at least in the first half of next year, but get a stimulus bill sooner. Cyclicals, as the economy comes back, cyclicals do better, right? We think we're out of the recession. We think we're in expansion now. A lot of the data, retail sales made new all-time highs like 4 months after the recession. So the consumer has really come back very quickly, honestly, more quickly than probably just about anyone would have expected. So cyclicals, as you can see, do better under Democratic presidents and when an incumbent party loses. So we like cyclicals. Renewable energy, we've heard a lot about why Joe Biden potentially could be positive for those. Immigration reform, marijuana legalization, obviously we've heard a lot about those. Trade policy, I want to spend a little more time on. Some of Joe Biden's policies are potentially weak U.S. dollar policies, and that potentially can benefit China and benefit Germany and open up the globe a little bit. And that's kind of what we've seen with the stocks, honestly, since the election, where Europe's done really well. Now, Europe's done better because of the vaccine also, but he might take some of the tariffs away and be a little more, I guess less aggressive, we could say. You don't have to probably worry as much about just a random tweet that comes out that can really change kind of the global structure. So that could potentially is a positive for those areas. And then guns, potentially more regulation actually means more gun sales in the near term. So we had a split Congress in all likelihood, like I said. Again, we don't know for sure, but that's what we're going to base our assumptions on, at least as of now, with the info that we have. But what does it mean? Well, tax and regulation, less of it, right? Well, there's going to be more taxes, more regulation. It's not going to happen now. So that's one, I guess you call it winner if you don't want higher taxes and more regulation. Technology, less chance of antitrust and regulations. So that's a positive. Healthcare is a huge winner. There's not going to be, there's just less chance of major reform, right? Without the Senate backing and major Senate backing and major House backing. So healthcare is one of our favorite groups really for the next decade or so, honestly. We really think healthcare is a good area that can continue to benefit. We continue to like growth over value. We've liked growth over value for a while. It's worked this year. Believe me, if you've watched the stock market the last couple of days, we had a huge move from value stocks did awesome. Growth stocks did not earlier this week on news of that Pfizer drug. But we think, it's just kind of a near-term blip, the realization that the economy, there's still issues, that the COVID is still here. We still think growth is where, the earnings are coming from. And in a low growth, low inflation, low rates world, which is where we live right now, growth tends to do better as investors reach for growth. So we still like growth a little bit over value. I mentioned cyclicals earlier, though, but on the value side of things, we've warmed significantly to materials. Materials and industrials are two that if the economy opens up a little bit more than people expect, those can do well. So we think, stick with over here who got you there, your growth names, your technology names, communication names. And over here, you can potentially invest a little bit in materials and industrials. Emerging markets, we've liked emerging markets for a while, and we still do. Again, kind of like I talked about with the weak U.S. policy, the weak dollar policy, that tends to be a tailwind for emerging markets. So from a diversified portfolio, globally diversified portfolio, we think emerging markets is an area that can do well. Like China. China makes up a big chunk of that. Nobody trusts Chinese data, but the Chinese stock market's really been strong. And I do trust Hyatt. All right. Hyatt, they give their comps. Hyatt said hotels, people are in hotels as much now as they were back in September in China. So China's really come back online. And again, that's a big second largest economy in the world. And that's something not to ignore. So at LPL Research, we thought, let's make sure I'm doing time-wise here. Okay, we're good. We thought the race would be a little closer. I'm just going to go through kind of some of the things we were seeing, why we thought this race would be closer, and why we thought a split Congress had a much higher percentage than what a lot of the other experts were saying. Too far. How stocks can predict the next president. Now, again, this one's likely wrong, but if you look at if the S&P's up 3 months before the election or down 3 months before the election, the incumbent president wins or loses. It's as simple as that. If stocks are up, the incumbent party wins. If stocks are down, incumbent party loses. Now, again, in likelihood, stocks were up during the 3 months before this election, and it looks like President Trump was obviously going to lose here. So you could say this one was wrong, but we still say this was kind of the market's way of suggesting maybe things would be a little bit closer when all was said and done. Approval ratings. President Trump's approval rating of 45%. We looked at all the previous, this is right before the election, all the previous presidencies and how much of the two-party vote they received based on their Gallup approval ratings. Well, you can see Bush 1 and Carter on the left there. They had low approval ratings right ahead of the election. Not surprisingly, they did not maintain 50% of the vote. You can see Johnson, Reagan, Nixon all had really high approval ratings when they were going up for re-election. And not surprisingly, they got big chunks and comfortable victories in their re-election years. President Trump's came out to a tad above 50%. Now, we know he did not get 50% of the two-party vote. But again, this was one thing that we were seeing that said, maybe this election could be a little bit closer than people think, and maybe that Senate can stay Republican. Incomes, when you have, this might be a shocker, when people have higher incomes, they tend to re-elect the current president. You like him or you don't, things are going pretty good. Now, there are some pretty big jumps in earnings this year. Incomes this year. That's because of the CARES Act. So put a major asterisk next to this, but still, there were some big jumps. You see Reagan, Johnson, Nixon all had high earnings. And I keep saying earnings. All had higher incomes. Got a big chunk of the two-party vote, whereas Carter and Bush 1, people weren't making a lot of money, especially when you factored in high inflation, and they didn't get too much of the vote. So this is another potential one that's maybe it'd be a little bit closer. So just kind of some things to think about, and that's kind of what we were out in record of saying. And again, why we thought after this election, when the uncertainty is over, if you have that divided Congress, maybe the market can go a little bit higher, and so far so good on that one. Poet and philosopher Henry David Thoreau. It's not what you look at that matters, it's what you see. So what we were told for weeks and weeks and weeks was higher taxes are coming. I've already laid out. We don't think that's the case now with the close races in the Senate and the House. But still, you can see here there's all the different, the blue is now, and the green is what was proposed. So potentially higher taxes. We heard a lot about, oh, higher taxes, higher taxes. What they didn't tell you about, though, was there's also higher spending. All right. Stock markets like spending. President Trump's one of the more liberal presidents when it comes to spending ever. Okay. And stock markets like that. Joe Biden's bringing with him potentially huge spending initiatives. You can see on the screen, he proposed $7 trillion in 10 years. Probably not going to get that now with the makeup of the Senate and the House. But still, there's a lot of spending coming in healthcare and climate infrastructure, education, higher education. I wonder what the difference between education and higher education. Probably could just combine those. Anyway, nonetheless, housing, you see it on the screen there. So there's a lot of spending, and stock markets tend to like that. So let's talk about earnings. Earnings this year are expected to be 132 on the S&P 500. So that's down from the previous year. They're expected to jump after the news with Pfizer. People think earnings might be up as much as 25% next year. So that's kind of that second column. But hey, there may be higher taxes coming. Now, again, they're not going to be as high as what they were, but this is something we were sharing before the election, just to put context around things. So you get a cut in earnings, right? About a 10% drop in earnings if you have all of the Biden tax increases. But what if you remove the tariffs on China? What if some of the negatives that potentially come from that are removed? Boom. You see on the right, earnings pop back up. So it's just so tough to say with President Trump or President Obama, well, this means this, because if you move that little chess piece, well, you got to move this chess piece over here. So there's some potential negatives and always potential positives as well, and vice versa. So just want to put some context around that. Now, in all likelihood, we don't have a Democratic sweep. I still want to share this chart, though, because there's a chance the Democrats, obviously, like we said, can have a 50-50 split with the Senate and have the tiebreaker with Ms. Harris, our VP. So what happens, though, when you have a split Congress? I'm sorry, a blue wave. Well, this is all the times in the past it's happened. Stocks are usually up. Everybody's worried about a potential blue wave. Stocks are usually up. You got to go back to Carter in 77, the last time stocks were down when you had a Democratic president and then both chambers of the House Democratic as well. So what happened, by the way, when we had a red wave back in 2016 that no one expected? Oh, all you had there was 15 months in a row of gains for stocks, or all-time record. So these I know I talked about gridlock is good, but still, if the economy is strong and the economy is improving, that's what matters. That's what we're going to talk about now. This is jobs, how long it took jobs to come back after all the previous recessions. I want you to focus on that green one that goes out past 8 years or 6 years. That's financial crisis. It took 6 years for all the jobs to come back. We're a developed country now. We're like a cruise ship. It takes a long time to move around. The truth is, it's going to take a long time for our economy to come back. Certain parts of our economy are already back. Honestly, my job, I mean, other than no one in the office ever, it's not like anything really changed. A lot of people felt the same. They work from home more. So there's some people that didn't even notice this recession, to be honest. But clearly, there are thousands and millions of people that are impacted. My father-in-law owns a restaurant down in Cincinnati, Ohio, a very popular restaurant this time a year ago, a little higher end. So don't do carry out, don't do DoorDash or Open Table, that stuff. Obviously, he's really, really hurting now. And then you hear that Ohio's governor was on the TV 2 nights ago talking about things don't get better in a week. They're going to shut down restaurants again. And I mean, it's just so devastating and so sad. The truth is, it's going to take a long time for jobs to come back. Look at that fish hook on the blue there on the left. That's now 22 million jobs. We got about 12 million of them back. So we got 10 million to go just to get back to where we were. So it's going to take years and years and years for jobs to fully come back after this recession, is the sad, sad truth. Here's another thing. I mean, I know all of you were wondering back in April, when the S&P goes up 12% in April, we're making new all-time highs by the summer, yet the economy was in really bad shape. Just today, 700,000 people filed for initial jobless claims last week. That's a terrible number, terrible. But it's the lowest we've had since March. So it's getting better, but it's still devastating. 700,000, that's still more than in the depths of the financial crisis, okay? 650,000 was the most we saw in 2008, people filed for initial claims. Just last week, we had more, all right? So that just puts it in perspective. But look at this cartoon that we have here. It says national prosperity up there on the left. Hey, wait for the rest of us. There's Wall Street stock boom. This was in 1928. That feels a lot like now, where the economy is just still struggling. People are really hurting, yet the stock market's just doing great. And it's caused a lot of, a lot of concerns, a lot of anger, honestly, between both sides. And there's no easy answer. I wish I had the easy answer on this. I mean, we do think a lot of it is we need to use fiscal policy. We've got monetary policy, the Fed, I'll talk about them, but we need to continue to use different levers on fiscal policy to help people that are impacted by this. An infrastructure plan. We had a big infrastructure plan in the 50s when rates were low the last time, to lock in low rates and really build our country up and help people. So we think kind of going that route can help, but it's a divide that is one that's going to take a long time to heal. It's not me who can't keep a secret. It's the people that I tell who can't. Abraham Lincoln. Now, here is the secret. How am I doing time-wise? Okay, we're good. I'll finish up about 10, 15 minutes. We should be good. I can talk forever on this stuff, so I got to make sure I don't get too into it. The secret is we've had huge fiscal response. That's, again, the CARES Act and likely the next CARES Act and the help that we've given the people that need it. Look at the blue. That is the fiscal stimulus plan, or the amount of fiscal stimulus that we had the financial crisis, so 12, 13 years ago. The orange is this crisis. I mean, the orange, there's China. Again, no one really trusts Chinese data, but the other ones we trust. And it just really shows. Look at Japan. I mean, 40% of their GDP has been put into fiscal stimulus. I mean, that's amazing. We actually been on record since our mid-year outlook last year, or this past summer, saying in the developed world, Japan is one area that we think could be a surprise in terms of upside action. Japan's gone nowhere. Literally, as we speak, guys, Japan's at 29-year highs. Japan's gone nowhere for 29 years. You could also say, well, they were down a lot. Now they're making 29-year highs. We think Japan's an area that really could do well with some new leadership and for a diversified portfolio looking for a different area. We like the U.S. Hopefully I'm making that clear. We'll talk about the U.S. stocks here in a second. We don't like Europe quite as much, but we do like Japan. We like emerging markets a lot, as I said earlier. Anyway, so there's a lot of stimulus. It is what it is, okay? You don't want to fight all that stimulus, which brings me to the next one, the Fed. The Fed's not going anywhere. Jerome Powell is not your father's Fed chairperson. He was on TV, I think it's 3 times the last 18 months, or 60 minutes last 3 times last 18 months. No Fed chairperson's ever done that. The Fed is the Fed. They are keeping rates low, potentially through at least 2023. They've got more bullets in the chamber. There's a lot of things they can do. On March 23rd, at the depths of the crisis that we had back in March, the Fed came out and said, that's it, we're done. We're going to backstop everything. We're just going to buy all these different bonds. Guys, the Fed is buying junk bonds right now, junk bond ETFs. I never thought I'd say that. I mean, the Fed is doing some just very, very unique things. And by the way, how prepared was the Fed for this? There's something called Fed stress tests. All you got to know is you hear about them every once in a while. They stress test the banks, right? They do all these crazy scenarios with the banks to try to see how strong the banks are for if we have another crisis. You know the highest the Fed stress test unemployment rate went to? This is way before, this is, let's say, a year ago when things were going just fine. 10%. We had unemployment way above that. Now it's fortunately back beneath, I think, 7% just recently. But still, so the Fed in its stress test of the worst case scenario didn't even have factored in more than a 10% unemployment rate. And clearly we had that obviously back, most of this year, honestly. So I'm not trying to knock on the Fed. I'm just saying how unexpected this was. But the Fed is there, and the Fed is not going anywhere. Jerome Powell had interest rates, had a decision a week ago. They left rates at 0. Everybody expected that. He pretty much said, hey, Congress, ball's in your court. You guys need to do something to help people. But the Fed is still there. And there's an old saying, don't fight the Fed. LPL Research upgraded our view on equities the last week of March. In the depths of the crisis, when a lot of our competitors were looking around, hiding under the table, cutting estimates, selling stocks, selling the stocks and things that you guys potentially own in some of your portfolios and models, we didn't do that. Okay, we said, wow, things look bad, but what the Fed just said, don't fight the Fed with as dark as things look. There were some positives, and we were out there all over the place explaining why we were using the opportunity and a lot of the money that we run. We added some equity risk late in March, and now looking back was obviously should have added a lot more looking back. But we're really proud of kind of how we went through a really, really tough time. And a lot of that reason we upgraded our view on equities in late March, and everybody else was really scared, was because the Fed came out and said they were going to do a lot of different things. People said the Fed's out of bullets. I couldn't tell you how many times I heard the Fed's out of bullets in March. They were not out of bullets, and there's not out of bullets again. So I'm not saying I agree with the Fed. I get it. Why does the president get to pick who's in charge of the Fed? Why is the Fed not audited? Why do we not know what the Fed is doing behind closed doors until a couple weeks later with the Fed minutes that come out? There's issues there, right? I get it. But still, the Fed is something we're not going to ignore from an investments point of view, as it still is more of a tailwind for equities here. Let's talk just briefly on the recovery. Everyone said what shape is the recovery? Kind of getting geeky to a degree. There's a V-shaped recovery, which you go down, you come back up. A W, you go down, you kind of bounce around some. We think a swoosh shape recovery, which is upper right, makes the most sense. You go down a lot, you start to go up, but then it gets harder, right? It gets harder to go up. And this is where we are, okay? The economy was terrible. The economy's come back. Manufacturing's at 2-year highs as we speak. Retail sales are at all-time highs. I mean, there are parts of the services have been strong. Housing data, my goodness. Anyone have a friend who's a realtor? I mean, it is crazy at how strong the housing market is right now. So there are some positives out there. And we think, but still, this economic recovery, we're getting to the tougher part where COVID is still there. We're going to have a vaccine eventually, but it's just going to take a while. So we think kind of a slow and steady type of recovery is where we are with the swoosh-shaped recovery. Let's talk about the stock market. How are we doing time-wise? That might go another 5 or 6 minutes, or at least try to, and then we'll do some Q&A. So let's go to the stock market. And I kind of talked about the stock market already, honestly, but we've got some more charts here to share with you. Where does it hurt? There's a headache, there's a stomach ache, and there's 2020. So I half joke, all it took was a 60% rally. Another reason we upgraded our view on equities, look at that chart, the Economist cover that came out in March, closed. That was the attitude, and believe me, it was scary. I mean, I'm not making it sound like it was easy. You guys know March was the most volatile month in stock market history. The Dow's been around since 1896. That's a long time. Actually, May 26th, 1896, if you or get to go on Jeopardy, but I wonder who's going to be in charge of Jeopardy. I hope it's not going away, but I don't know, maybe get like one of those hologram Alex Trebek's. That'd be good. Or just do all the old questions for the last 30 years. He can do all them all over again. But anyway, you had that closed cover that marked the lows, right? It's a funny way with magazine covers. There's something called the magazine cover indicator. When everyone's thinking one thing on one side of the boat, that's when things tend to go the other way. And boy, the third week of March felt terrible. It was unbelievable how volatile the stock market was, the sell-off we had. But then sure enough, closed came out. Then we had a 60% rally into September. Check out the cover that the Economist came out with in the middle of August. Free money. There's a machine that literally spits out money on the cover of The Economist compared to the one they had 6 months before talking about how the world closed. Sure enough, on September 2nd, there was a major peak, which we still haven't popped above, by the way. Then a quick 10% sell-off, volatility ahead of the election. So it's never that simple, but I thought that was really interesting, the way The Economist has nailed the major peak and near a fairly major high in the stock market after a 60% rally. So this is one of the strongest bull markets to start to a bull market ever. You've heard that before. Also, it's one of the fastest, most vicious bear markets ever. So I'm just kind of making up what we lost. But here's what's fascinating about this to me. The dark blue there is the current bull market and where it ranks with all the other first year of bull markets in history. This has been one of the strongest ever, in line with 2009's bull market and 1982's bull market. You might hear those 2 years and think, well, those were the starts of some really spectacular gains. It might happen again. We're optimistic of that we could have some years left. The average economic cycle lasts 5 years, okay? Last couple economic cycles lasted like 10. The most recent one was 10 years of economic growth. But we think just because this economy, we might be in expansion for like the last couple of months. I mean, we probably just ended the recession in March. So I'm sorry, in August or so is what we think. So there could be years left of this expansion in our view. That can help equities. But what we really want to point out there, the green, and I guess that's gray, the two previous best starts to bull market ever. You know what they did after 6 months? They continued to be strong. This is a chart we've shared a lot the last several months, saying if we follow the path of the two previous bull markets, you tend to see upward bias. And that's exactly the play that's continued to play out, and one that we would not want to vote against. Have to have a Mark Twain quote. I love Mark Twain. He's got some awesome quotes. October. This is one of the peculiarly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. October indeed is the worst month of the year during an election year. As we show here, you can look where it says October and you see that green that goes down. That's an election year. The green is election years during the month of October. We said that we're on record many times saying, you know what, some pre-election jitters make sense. And that's exactly what happened, where we had a really rough sell-off in stocks in October. Then we also said the last 2 months of the year tend to be pretty good. Once you get some type of resolution on the economy, Santa Claus comes to town, good feel-good time of the year, stocks tend to do well. And as I said before today, November is up like 8% for the month, I think, approximately for the S&P. Long way to go. I get it. But still, that's one thing that we think maybe we kind of end on a high note. Something else to think about. Let me go to this first, then we'll go to Lou Holtz. Big fourth quarter on the way, right? Actually, no, let's do Lou Holtz first. So life is 10% what happens to you, and 90% how you respond to it. Lou Holtz. I love that quote by Lou Holtz. I mean, we can't control what happens to us. We can only control our response to it. And one of the responses we've seen to the devastation that we've seen with COVID and the recession is strong equity prices. I mean, that's the truth. Now look at this. The third quarter historically is a weak quarter for stocks. It's just the way it shakes out. August, September aren't all that great for stocks. We had a huge third quarter. You can see on your screen there, 8.5% gain for the S&P during the usually weak third quarter. So I took a look and said, hey, what do stocks do in the fourth quarter, which is normally strong, in the fourth quarter when you have a strong third quarter? Guys, as you can see there, the fourth quarter has been higher every single time. Going back to 1950, up over 7% on average. We're on record sharing this, and this is a reason to think if there's a dip in October, you might want to buy it. And we did that in the portfolios we run for our clients and for our advisors. And we're out there saying this in the media, in the we do podcasts and videos. This is the data that we were sharing. And we had that pullback in October, and now we've had the snapback. And this is another way. What Mark Twain said, history doesn't repeat, but it rhymes. The strength we saw in the third quarter was kind of a signal that maybe there could be some continued strength in the fourth quarter, and we think that's the case. So we've liked large caps over small caps for a while. Large caps have done very well. 2 months ago, we upgraded our view on small caps. Small caps are more domestic by nature. If the economy is doing good, U.S. economy, small caps do better. If the U.S. economy is doing poorly, which it clearly did most of this year, small caps don't do as well. Small caps have been soaring higher the last couple of months. Honestly, since we did our upgrade, it seems like someone wants to listen to us, actually, or we got lucky, one or the other. But small caps are doing really well. And we think there's some opportunity, finally, after large caps have done great for years. Now this new expansion is starting. And what we're sharing on the screen here is a chart we shared in a weekly market commentary that we did a few weeks ago. After a recession is over, and again, this recession is not officially over. We say it is. We think it is, looking at the data we look at, but it's going to be called like a year from now and retroactive. But let's just say it ended sometime in the third quarter, or summertime or third quarter, which is probably accurate. You can see here 6 months later and 12 months later how the S&P 500 does relative to large caps. I'm sorry, how small caps do relative to large caps. Put a bow on this. Small caps do really well 6 months to a year after a recession is over relative to large caps. Doesn't mean you shouldn't invest in large caps. We still like large caps. We'll be very clear there. But maybe there's some opportunity in some small caps as the economy gets better. Something to think about. A couple more charts here, and then we're going to wrap it up and do some Q&A. So I grew up in Ohio, eating KFC most of my life, Kentucky Fried Chicken, the Colonel. My son Gus just turned 8. About a year ago, he was 7 years old, and we were driving around Charlotte. True story. He was, hey, Daddy, you see that guy up there? I'm like, what are you talking about? He's the guy. I was, oh, yeah, the Colonel. I said, yeah, that's the Colonel. He goes, again, this is a 7-year-old. The way the 7-year-old mind works, amazing. He goes, hey, Daddy, why is his body so small? I looked out. Oh, my God. I'm 42 years old, and I've never thought that. I've thought the Colonel wears just a goofy tie my entire life. You get someone with a different perspective who's just totally fresh and green and doesn't see things the way that you maybe are supposed to see them. And now he sees a guy with a small body. Now the rest of your guys' life, you'll see the Colonel and think of the same thing. But we all see things differently. All right, how fun is this Thanksgiving going to be after the election and the election that just won't end, and how we all get the same information. We all get different opinions on a lot of things. So good luck at Thanksgiving, everybody, this year. But what's one place we agree? And then we're going to wrap it up. One place we can agree is earnings are improving next year. That's what I'm showing on the screen here. 2021, you're going to have higher earnings growth in U.S., developed international, and emerging markets. We had an earnings recession this year because we had a vicious recession in 2020. And honestly, 2019, as you can see there, the U.S. eked out some gains, negative earnings growth, the other places. Now, what we've seen this third quarter earnings is truly amazing. Over 85% of companies in the S&P 500 beat earnings estimates. That's an all-time record. What they had to say about now, the bar was low. Get it. The bar is historically low. But still, what they had to say about the future, they're upping future guidance. That usually doesn't happen. So corporate America is really seeing some positive signs. Small businesses, I know there's definitely some small business owners out there on this call. There's something called the NFIB, small business. I think it's called the Small Business Optimism Index, but it's by the NFIB. And small businesses are extremely bullish about the future. And they have a much better track record than guys like me, than economists out there, than the Fed. Honestly, the Fed's had some really poor calls, honestly, if you go back in history. I'm not going to go over them now, but they don't have the best track record. Small businesses have a really, really good track record, and they're quite optimistic about the next 6 to 12 months. So I wouldn't want to bet against small businesses and the wisdom that they provide. But back to this chart. There's a lot of earnings growth coming globally. The truth is, yes, the president matters. The makeup of Congress matters. At the end of the day, how the economy is doing, if there are earnings from your investments point of view, tends to matter more. You can have a down year without a recession. Absolutely can. 2011 it happened. 2018 it happened. We didn't have recessions. Your stocks lost money those years. But huge losses are extremely rare. So just kind of be aware if the economy continues to open up next year with the fortunateness that we're going to have probably one vaccine and likely another major breakthrough with Moderna's results, which I think are supposed to come out next Wednesday. I think, don't quote me there, but pretty soon. Those are some positives. So we're going to wrap it up here. Why it pays to think outside the box. My doctor said to start working out, eating healthy. So I started eating like that. I don't know if it worked or not, but I tried. And then lastly, enjoy the moment. There's my dad. He passed away a couple of years ago. It's my kids and I went to a Xavier game. This one, Xavier University in Cincinnati beat Villanova. So a pretty awesome moment. But again, without our health, none of this stuff matters. And obviously we've all been impacted by COVID and the recession and the impacts of everything that's happened one way or another, some clearly more than others. So from everyone at LPL Research and LPL Financial, our thoughts go out to everyone to stay healthy. And here's to a much better 2021. We think, again, this bull market can continue, the economy can open up, but let's just get some vaccines and continue to be healthy and be safe. So with that, I think, how are we doing time-wise? Yeah, I got about 10 minutes or so. So I got to show these disclaimers just to keep the lawyers happy, but let's do some Q&A, Dan.
Okay. I'm going to remind our viewers that they can submit questions through the chat function. If you don't submit questions through the chat function, I will ask questions and we'll all be embarrassed by that. So please do submit some questions. I know you probably have some. Ryan, that was a tremendous presentation, a great deal of information, and I believe portrayed in a unique manner here. I do have one question. You as researchers tend to do, you went back into history a lot. To see trends and to see reactions to recessions and politics and stuff like that. Not just stuff like that, but other things too. But let me ask you one thing that is different in 2020 is the virus, COVID-19. Is that going to make a difference in some of the things that you say follow different political events and follow different economic events?
Yeah, awesome question. Tough answer, but the truth is it very well could. Remember when I mentioned how the stock market had been right 20 out of 23 times ahead of the election? If the stocks were up, the incumbent president wins, and down. Those 3 times it didn't work were 1956, the Suez Canal crisis, 1968, Vietnam, and 1980, the Iranian hostage crisis, a major geopolitical event in each of those years. And now this year, stocks were higher ahead of the election. We had COVID, all that came with, and President Trump likely will not win. So right there tells you, what do they say? Sir John Templeton said the 4 most dangerous words: this time is different, as it pertains to investing. So I'm always leery to say this time is different, but it is. You are absolutely right. There's no question this time is different. But at the same time, what gets me, try to keep this very simple. Look at the action in the bond market. I didn't really talk too much about bonds. We can maybe do that in the Q&A here. But the action in the bond market, yields dropped like mad back in February, way before the stock market started to crack. The bond market freaked out and got worried. What's the bond? You could argue the bond guys are some of the smartest guys in the room. Right now, what's the bond market doing? The 10-year yield's been strengthening, going higher, suggesting potentially a stronger economy. And those are the signals that we tend to follow. And when you see things like copper versus gold, copper's industrial metal, gold precious metal, copper versus gold, copper's doing better, 10-year yield's going higher. Those are the signals that, again, suggest probably an improving economic backdrop. But you're totally right, Dan. This time is different. Well, I guess we had a pandemic in 1918, but still, it's tough to use the future. Use the past to predict the future when you have something as rare as this. But the bond market is the smart guys in the room. They tend to suggest the economy is going to do a little bit better, and I like having that wave to follow, if you will.
Good. And we do have some questions pouring in here.
Great.
As we speak here. One of them is, Ryan, how do you see the pressures on local and state budgets playing out in the future in cities that are under pressure due to lower tax revenue and now higher social costs?
Yeah, well, the issue there is I don't think they're going away anytime soon, is a sad truth. I mean, with there was likely going to be more support if you had the blue wave for the local and municipalities, right? I mean, that was what the play was. Now I'm talking about a potential $1 trillion stimulus package versus a $2 trillion stimulus package that was there. It likely won't be higher. There won't be the higher taxes to bring in the more revenue. So it's a very difficult situation. I guess the thing that I hate to use hope. They say hope is not a strategy, but we can just hope that the economy continues to open up and continues to get consumers out there spending money and get things moving again. But the truth of the matter, as it pertains to the municipal level and the city and the state level, there are some issues there that are really going to be difficult to fix right away. Is the sad truth.
Let me ask you another question from a viewer. Does China's economic strength growth threaten the U.S.?
Yeah, I mean, China's the second largest GDP in the world. Japan's third. We're first, and I think it does. I mean, there's no doubt about it. I mean, there are some. One of the unique things about U.S.-China relations. Obviously, President Trump was very tough on China. Joe Biden makes it sound like he's going to be tough, but maybe not quite to the extreme of President Trump. One of the few places, there's not many. One of the few places that Democrats actually agreed with a lot of what President Trump did. You look at what Schumer was saying and some of the other main Democrats. They were okay with a lot of the tough policy, a lot of the tough trade rhetoric that we've had with China over the past couple of years, to be honest. So that's going to be unique to see how that all plays out with Joe Biden's policies, with some of the other high-ranking Democrats that have been okay with being tough on China. But there's no question if we have a weaker U.S. dollar, less tariffs on China, that could help strengthen China. And it could hurt the U.S., sure. I mean, remember what I kind of talked about. We like emerging markets here. Now, we still like the U.S. I mean, we still like U.S. stocks, but I wouldn't be surprised at all if the next 2 to 3 years, emerging markets potentially outperform the United States. This third quarter, U.S. earnings are going to be down, we'll call it 7 or 8%. Emerging market earnings in the third quarter is going on right now, or just ended. We're seeing positive earnings growth. A lot of that's because China is really growing. So it could take away some from the U.S., but from an investments point of view, the way we're managing the billions of dollars that we have, we're moving a little bit toward emerging markets to potentially kind of offset some of what could be taken away from the U.S.
Okay. Let me ask you another question. You had a slide in there that showed Japan invested heavily in, I don't know if it's all stimulus or if it's in healthcare or what it's in reaction to the COVID things. I also understand that Japan has one of the lowest infection rates in the world right now in a country that's tiny and crowded. Tiny geography-wise. I don't mean anything other than that. Is there a connection between effectiveness and the amount of money they've spent to prevent and to combat COVID?
That is a great question. I've never quite thought of it like that, but hopefully if you still see the slides, I pulled up the slide that we were talking about, the fiscal stimulus as a percent of GDP. One reason that we think Japan and honestly China and other parts of Asia are doing so, in South Korea, they're doing so much better fighting this is they've done this before, right? I mean, my mother-in-law lived in Japan, 45 years ago. She said, 45 years ago, everyone was wearing masks. I mean, it's obviously new to the United States to wear masks. So I think partially they had their outbreaks in March and April, but partially some of the reason Asia is doing so much better than the United States is they've been here before. They've done this before, but that's a real interesting point. I mean, they've put a lot of money into beating it, and you can see that. Now, the U.S., where's the U.S.? U.S. is about 10 or 11% or so. That'll probably go up to 20% when we get the next potential stimulus deal here. Maybe not quite 20%, but it'll go up some. But very good point. We've sided more with the fact that they've done this before, and they've been wearing masks a lot longer. So that's potentially why they're under control. But It very well could be, But then again, look at Germany. I mean, Germany's the second one on there. They put a lot of money in the stimulus, and they're still having all of Western Europe are still having some major structural issues. I mean, just today, the German 10-year Bund, so that's their yield, right? The German yield was like the lowest it's been since March. Remember, I mentioned the U.S. 10-year yield is like the highest it's been in a long time just yesterday. So that's the bond market's way of being a lot more worried about what's going on in Europe and specifically Germany versus what the bond market's potentially saying here in the United States. So awesome question. I just don't know, but that's a real good way to look at it. Interesting way to look at it, I should say. Yeah.
Let me ask you another question. Normally, without a divided and split Congress, under a Democratic president, especially maybe more so now, there'd be less defense spending versus other kinds of spending. What kind of an impact on the economy would you expect from that?
Well, yeah, no, there's no question about it. I mean, that was one of the potential President Trump wins would have been, financials and energy and defense, as that's where a lot of the spending would go. But at the same time, so that potentially can impact the defense. There's no question about it, that area. At the same time, you look at like green energy and solar and some of the other potential areas that President Biden's potentially initiated a lot of spending. Those areas are going to make up for it, in a way. So it's a kind of, moving from one area to the other, but it's a unique situation. But at the end of the day, there's still a lot of spending coming from potential President Biden or President-elect Biden, I should say, and that's still factored in, and we think that's why the stock market's reacted as strongly as it has. But clearly, it's not his policies are not a tailwind for defense stocks. It's just very clear, I think.
Well, I noticed in your chart of that the chart after the tax increases that maybe would have happened under Biden.
There it is. Spending, there it is.
The spending, I mean, I don't know if anybody could argue with the nobility of those items that are listed as increasing. But certainly the taxes, the small business tax increase that was listed on that slide was rather frightening, since small businesses have been impacted tremendously by the recession driven by COVID.
Yeah, and I should have the chart up there. It's in the middle. Small business current tax rate about 30%, proposed 52%. I mean, you're right. That's partially why markets have reacted as positively as they have. But I'll also take a look at this. After the Great Depression, the government increased taxes. The government increased regulation, and the government or the Fed increased rates. Now, that I should say after the crash of '29. So that was the start of the Great Depression. Those policies likely extended the Great Depression. Well, nobody knows for sure, but likely extended the Great Depression potentially for years. So one of the things we were saying, even if we had a blue wave, will there be higher taxes coming? Yeah, probably, but maybe not right away or not as soon as people thought, because again, we have an economy that's just coming out of a vicious recession. It's on weak footing. I don't think the thing to do is massively increase taxes, massively increase regulation. Like you said, go to small businesses, a 50% tax rate or proposed tax rate. It just didn't seem like the thing that would be as wise to do. And that's again why we think the markets reacted so positively to the split Congress and the likelihood that the things on the screen are not going to happen now.
Ryan, one other quick question that interests some of us in the room, and that's about interest rates. You talked about the Fed is determined to keep rates low, maybe even through 23. The 10-year rate has increased quite a bit just in the last month or so, or a couple of weeks maybe. What is driving that? And is that a sign that rates maybe aren't going to stay low, at least market rates, despite the Fed?
Absolutely. Yeah, we think market rates could go higher. We think the 10-year yield this time next year, let's say, could be between 150 and 175. Good deal higher. Isn't it funny though? If 30 years ago we had this conversation, we were talking about the 10-year yield at 1%. How like, oh, it's a 1%. Like 30 years ago, you're like, you're crazy, 1%. But I mean, yeah, we think that's the case. And I mentioned copper gold earlier. Copper historically is a good sign for the global economy. Copper's been really, really strong. Some of that's due to Chinese demand. I get it, but it's correlated to the 10-year yield. So we think the 10-year yield can absolutely go a little bit higher market rates. The Fed has said what they've said. They're likely not going to increase rates for potentially years here, but the 10-year yield absolutely can go higher. Remember the yield curve? All everybody talked about was probably when I saw you guys a year ago, we talked about the yield curve. All everybody talked about was a yield curve. The yield curve is the steepest that it's been all year. So there are some positive things potentially happening. The bond market is telling us there can be some positive things happening. And everyone hears higher rates. I think negative things because that's just the way we've seen for 10 years. Historically, higher rates, a little bit higher 10-year, historically means the economy is doing pretty good. A little bit of inflation is not a bad thing. So that could be more of a normalcy. Getting back to normal would be so nice to see some of those things. So we think a little bit higher 10-year this time, if I get to come back and see you guys in a year, is exactly the way things could shake out. And that means probably better economy.
Well, we certainly hope you'll come back in a year and talk to us.
Invite me, I'll be there. Let's do it in person next year. That'd be fun.
It's been fascinating. If there are no other questions in the chat room or whatever that thing's called, we'll remind everybody you will get the slides sent to you electronically. Thank you. Ryan, it's been nice to see you virtually. And thank you for a really great presentation.
The honor is all mine. Everyone on the call, you guys are in great, great hands. Huge fan of Exonia Bank. If there's anything LPL Research could ever do, you guys know I'm an email or call away. But yeah, just had a fun hour with everybody, and hopefully everyone has a great holiday season and a great 2021. Thanks for having me.
Okay, well, before you go, I'm going to turn it over to the president of the bank, Mark Wehrman, for some closing comments. Thank you.
All right. I just want to say thanks again, Ryan. Really great presentation, great summary of where we're at and where the economy has been and where it's hopefully headed. I think it's really interesting to hear some of the historical perspective, not always a perfect guide as to what might happen in the future, but certainly a good place to start. And I think it's really encouraging to hear that there's some good optimism for 2021. So, the economy means different things for different people. It affects our customers differently depending upon what kind of business they're in. We just want to make sure we remind all the customers that are viewing with us today that at Exonia Bank, we're here to help you, whether you're a small business, medium-sized business, or an individual. So call us and we will try to help you navigate these uncharted waters for 2021. Again, thank you to Ryan and LPL for being part of the presentation today, and hope we can have you back next year, hopefully in person. I also want to thank everyone who joined the call, all our customers. We really value everything you are for us. And again, thank you to Jeff Taylor and Brianna Smith from LPL or from IWM, Exonia Wealth Management. So as everyone knows, there will be a recording of this available on our website here relatively soon. And you should also be aware that shortly after this, Dan and Ryan are going to be producing a podcast that'll be available sometime in the near future as well. So you'll get to hear more from Dan and Ryan on what's going on in the economy. So I think with that, we will end the presentation. Thanks again, everyone, for joining us today. Really appreciate it.